But, if we're going to electrify the planet, we're going to need a lot of spending on the grid, and we're going to need a lot of metals, right? And so I do think we're in kind of the commodity super cycle. And of course, it's not going to be a straight line, right? But I think we're in for the next decade, at least, where we see, higher commodity prices.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have an awesome discussion lined up, and we're fortunate to have with us TRACY SHUCHART. TRACY is the founder, CEO, and chief market strategist for Hill Tower Resource Advisors. She manages an energy and materials portfolio for a single-family office. She hosts the popular Mic Drop Markets podcast and Mic Drop Markets X Spaces. And TRACY is a regular contributor on the energy markets for Fox Business, Bloomberg, Dubai News, CNBC, and many other outlets. TRACY, thank you so much for joining us today.
Thank you. How are you doing?
I am wonderful. Okay, let's start with U.S. sanctions. The U.S. is talking about more sanctions, and this time it's going to be Russia's palladium that is now in their crosshairs. Palladium would get added on to a long list that they are already sanctioning if it passes. Between the long list of base inputs being sanctioned, all of the worker strikes that we've been seeing from the longshoremen, Boeing, the pilots, and others this year, where their contracts have all been amended with huge raises, that's going to affect the prices of everything. And then on top of that, overlay the massive debt. How will the U.S. avoid more inflation moving forward?
Well, that is the jackpot question, right? That's the $1 million question. We all are wondering that. And, we just had PCE come in, and it was a little bit hot, or at least it was, it was to expectations, but we're still running higher than where the Fed wants us to be, right? And so, it is really hot. Do I think that we can avoid inflation? Yeah, probably not in the near term. I think we're going to see inflation kind of rear its ugly head once again, just as the Fed thinks they have this all figured out and are going to start cutting aggressively. Well, at least that's what the markets are factoring in at this point.
So are you thinking that it's going to rear its ugly head again here after the election, 2025? Do you think we have a few years before this next big wave comes in?
I think we're going to see it in 2025. Certainly, the election will have a lot to do with it, but it depends on who wins and if it's a landslide. What I fear is, what I would like to see with this election, to be honest with you, is gridlock. Like, I don't want to see a sweep in either direction, because I think that would only exacerbate inflationary pressures, because you're going to have fiscal spending up the wazoo. So the best we can hope for is kind of we have gridlock in Congress, in my opinion, and they could stave off some of that inflation for a while.
Well, that is something that the founding fathers kind of created when they built out this system. It was intended to create gridlock so that we didn't have one group coming in and doing some massive overhaul. But TRACY, China cut rates after the Fed did. They injected hundreds of billions of dollars of stimulus into their economy. They're now talking of injecting trillions. The EU central bank cut by 50 basis points. Canada's central bank says more rate cuts are coming for them. Others around the world, they're cutting too. Is all of this rate cutting and cheaper money setting the stage for a huge commodities price spike? And if so, how long do you expect that cycle to last?
Well, absolutely. And I thought we were in kind of a new commodity super cycle starting, a couple of years ago. And it wasn't just because everything crashed into 2020. It was just looking at kind of the policies moving forward, particularly with this green energy push. And I know we've kind of seen that pull back a little bit. But, if we're going to electrify the planet, we're going to need a lot of spending on the grid, and we're going to need a lot of metals, right? And so I do think we're in kind of the commodity super cycle. And of course, it's not going to be a straight line, right? But I think we're in for the next decade at least, where we see, higher commodity prices, which also adds to inflationary pressures. But, and it's really interesting if you see, what gold and silver are doing. And obviously today, we're recording this on Halloween. We have seen a pullback in palladium, platinum, silver, and gold today. But still, that's after hitting highs. So, expect pullbacks in this market. But I think going forward, we're still on a trajectory moving higher for commodity prices in general.
So it's been said that what gold does is that it maintains your purchasing power, that there's points in time in history where that's less important, and there's points in time in history where that's more important. Is right now one of those points in time in history that it's more important to focus on maintaining your purchasing power?
Well, absolutely. Look at our debt to GDP ratio, just not even in the United States. Look at Canada, look at China, look at Europe, look anywhere. I mean, this is huge right now. And, I think that gold has kind of been sending markets a message. And and what's incredible here is that we really haven't seen retail traders jump onto this trade until recently. Right? It really started with buying from the central banks, because they didn't really care when they were going to buy that. And that had to do a lot with us kind of confiscating $300 billion from Russia and then now loaning it to Ukraine. And that kind of sent off warning signs to other central banks, because they're like, hey, the US is our friend right now, but, if we get on their bad side,
Right.
are they gonna withhold our holdings at the Federal Reserve, right? So I think that's really what set it off, and now we're just starting to see kind of retail jump on this trade right now.
Yeah, someone said recently, or maybe right after the invasion and the sanctioning, that was basically the U.S. telling the world it's now time to buy gold.
Well, yeah, I mean, it sent chills down other countries' spines, so to speak, right? They're worried that um, that this could happen to them too, and
Exactly.
rightfully so. You never know.
So, Tracy, Paul Tudor Jones, in a big CNBC interview last week, he stated that post-election, I will own 0 treasuries and I will be shorting the long end of the curve. Stanley Druckenmiller, he also recently exposed that he has a huge bet of about 20% of his portfolio that's shorting the long end. Is the Fed losing control of the bond market? What's going on here? And is gold going to be basically the default winner at the expense of long duration bonds?
I think so, absolutely, and that's what we're kind of already seeing. And what I would watch too is, we're kind of hitting the point in yields where it's spooking indices again, right? And so we're kind of, yields hit where we hit in July, which kind of started spooking the markets. I mean, we've had volatility this whole year basically, but with some pullbacks. But I mean, we're starting to hit the point in yields that it's spooking the broader markets. And so I think that's something that investors really need to be cognizant of as well.
Yeah, if my memory serves me correctly, what happened overseas with the UK gilts that preceded the banking crisis here, and today I think there was a story that broke that there's some major issues breaking out over there again.
Over the gilts. Well, remember it was in September of what was it, 2023, I believe, where they had to the UK central bank had to intervene again, right? Because there was a problem. They lost control of their bond market, and so I think the markets here are telling us that they don't really have much confidence in the Fed right now. If you look across all the asset classes. Now, I think U.S. markets will still do well because I think money will still come to the United States, uh, being that it's the most liquid market in the world. And so I don't think we're in for a market crash or anything like that. I'm not saying that at all. I'm just saying markets could get more volatile than we are used to seeing.
So the BRICS, they're focused on de-dollarization. Everybody's been paying attention to this, and basically as a way to avoid being sanctioned, like you were talking about in the future. As de-dollarization progresses, the BRICS nations, they're going to increasingly trade in their own currencies, and they're going to settle their net balances in gold. We're already seeing that uptick in the data. Do you see this shift as driving up both the demand for gold and gold reserves held by BRICS countries, thereby basically increasing the floor under gold prices and gold demand?
Oh, absolutely. But I will have to say, if we're talking about BRICS, I know they want to de-dollarize. I want to, we're probably never going to see this in our lifetime. Yes, they're making steps towards that, but they have a whole lot of hurdles going on right now, particularly with, who are they going to have what central bank are they going to trust? Certainly not PBOC. So, and I think even though we've seen more members kind of join that group, including our friends Saudi Arabia, at the same time, Saudi Arabia is still selling dollar denominated bonds. They're not selling yuan denominated bonds or ruble denominated bonds. And so again, I think this is going to be a very slow process, and likely we won't see it in our lifetimes. I know a lot of people are saying, oh, we're going to see it in 5 to 10 years. But in reality, the cohesiveness of that group really trying to, form even a central exchange like SWIFT is very impossible right now. But as to the gold trade, absolutely.
But even putting aside the idea that they could fully de-dollarize and get away from the US dollar and treasuries 100%, even on the margins, there would be impact, right?
Well, of course, you're going to see impact, but are we talking about the gold market, or are we talking about impact to the dollar?
Maybe both.
But again, I agree with you on the gold trade. I think that, I think we have kind of set the floor for gold at this point. Again, I like to see pullbacks like today in the market. I don't like parabolic markets because they tend to revert to the mean, and that gets really messy and ugly. And so, I personally like to see, I would like to see these kind of like $300 moves up, $100 move back, 300. Like, let's stair step this and not make this a parabolic market. That said, given what you have talked about BRICS, I do agree with you that we have set some kind of floor, at least for right now, in the gold market. And I think that really when we saw gold kind of go, race above that kind of 2000, that triple top, right? That multi-year triple top. I think at that point, there was just no looking back.
So, Tracy, I'm going to throw some stats at you here. In 1955, the U.S. had enough gold to cover its liabilities to other central banks and governments. And at the time, that totaled about $13.5 billion. At that time, American gold reserves exceeded official dollars abroad by over 160%. By the summer of 1971, when Nixon pulled us off the gold standard, America had only 25% of what was needed to make good on its commitments to exchange gold for dollars. Today, assuming that the reported U.S. gold holdings are even accurate, America currently only has about 8 to 9% in gold as coverage to pay for its foreign debts. So getting back to that pre-1971 pulling us off the gold standard moment of 25% coverage, gold would need to 3x from here. What path do you see gold taking?
Well, I think that, I have been a strong believer in gold for years now, even though it was a sideways market for a very long time. I think gold's going to be a very important asset, and one could argue Bitcoin could be too. Don't ask me about Bitcoin, though. I'm highly not an expert on that. I prefer hard currency. But, I think there are alternatives, and I think gold's going to be increasingly more important as we kind of become a multipolar world, instead of kind of this, global world where it's, we have centralization on the West, basically.
So there seems to be a rotation happening right now away from ESG funds. Where do these investment dollars go if they aren't into the ESG funds? Who becomes the big winner from this kind of rotation?
Well, I think that, I think a lot of these funds are realizing that it's just not popular anymore. And so um, it's kind of a two-tiered thing. So you have people moving away from ESG, as we've seen a lot of these oil and gas companies. In particular, we've seen, and the majors, BP, Shell, um, Exxon to some extent, but they didn't really get into those renewables ESG. But we've particularly seen where they're pulling back on, say, their wind and solar projects and focusing more on their core business. And investors seem to like that. And since they've been doing that this year in particular, their stock prices have shown that the investors like this. So you have kind of that, the physical thing that's happening in the market with people pulling back from these projects. And then if you look at the investment side, I think a lot of these ETFs, I mean, we had a ton of ETFs come on the market when ESG was all the hype, right? Anybody put ESG on their name for any ETF you possibly could have seen. And if you actually looked into those baskets, half of them had oil companies, half of them had mining companies, coal mining companies were in some of these ESG baskets. And so, it was just the name, and the investors liked that at the time. But now we're seeing a shift where now they're not doing so well. So they're taking ESG off their name, right? Which is, for a lot of those, more reasonable considering what's in those baskets. But you're also seeing things like BlackRock today took ESG off their ESG ETF, one of their most popular ETFs today. They didn't change what was in it, which was actually an ESG, but investors are not liking that, so they just took the ESG name off of it.
It's amazing. Well, Tracy, in the past 50 years, the mining companies have exhausted the most accessible gold deposits. So now mining gold is more challenging due to the increasing depth of deposits. That's just one of the reasons. With growing global demand for gold as a trade settlement currency and an inflation hedge protector against purchasing power loss, do you see the stage as being set for a significant price increase here?
Well, absolutely. And you also have to think that it's not just that it's getting harder to mine. It's also the mining industry suffered exactly what the oil and gas industry has, and that's lack of capex for the last decade, right? And so because nobody likes mining, it's dirty, it's right, and so there was no capex into this industry, and it's not just gold. It's a lot of other metals as well. But so you have lack of capex, you have mining for it's getting harder. We're going to start to see this in the shale industry, where it's where our wells are getting gassier and gassier because there's no capex in that industry either to build. It used to be drill baby drill, and banks got burned, VC got burned, private equity got burned. Nobody wanted to touch it anymore, and so now we have gassier and gassier wells. Tier 1 acreage is burned through, and so it's going to get harder and harder. And yes, we have seen more production of the U.S. of shale, but people aren't looking at what's actually coming out of that. Most of what's coming out of that can only be used to process chemicals, not so much oil. But again, I'm just kind of pointing out the similarities in both industries, because we see this in metals mining as well.
So, Tracy, what do you see as the ramifications of the miners being starved of all this capital for the last 10 years? What will be the end result ultimately of that, whether that's 2025 or 2027 or 2030? What is coming down the pike? What are we staring at?
I think what we're going to see is what oil and gas went through. And I think you're going to see a lot of mergers happen, a lot of mergers and acquisitions. I think you're going to see a lot of companies buying mining production rather than investing the capex. And
That's
so,
actually starting now.
right. And so, I mean, literally, again, oil and gas is the model for exactly what I think is going to happen in the mining industry. And that's actually a good thing. Like it's going to be a good thing, but obviously prices are going to get higher. Now, the flip side of this is that the higher the price is, you have some of these junior miners really have the advantage turn here at this point. Because if, for example, silver, if we can hold above 30 for any length of time, you're going to start seeing the silver miners really start to move. And we're already beginning to see that because we have been holding against that. So, I really like some of these up and coming junior miners, particularly in the United States right now.
Okay, interesting. So we're going to move into silver here in a moment, but I want to ask you about the gold to silver ratio. It's been a fairly good predictor through the decades. When the ratio is elevated, it takes more silver to buy gold. Those who buy silver, they benefit, vice versa. Some say the ratio is no longer relevant, though. What do you say about the ratio, and where do you see the gold to silver ratio headed?
I think it is relevant. I don't want to say that it's not relevant, but I would say it's not as relevant anymore as we've kind of moved into this into the green energy spot, because that's really taken silver out of purely like a precious metal play. Yes, we use silver in medical, but right now, we've turned from like silver being 75% precious metal, 25% industrial use, to moving that to 45% industrial use and 55% precious metal store of asset store. So, and I think that's even going to keep moving. And so I think that's kind of why we're seeing the shift in the gold silver ratio, and why it may not hold the relevance that it once did going forward.
That said, do you have an expectation on which way you think the ratio is going to move, or up or down from where it is? It's roughly in the 80s right now.
80s right now, right? I think you're probably going to see that move higher.
Higher. So, Tracy, silver's crossed some very important thresholds this year between $26 and $33. It's been in a substantial and rising deficit for the last 4 to 5 years. AI data centers, EVs, solar panels, the electrification of everything, the rising up of more than 1 billion people globally into the consumer class. All of this requires large amounts of silver. We're not even touching on the expanding military applications that require massive amounts of silver. Clearly, demand is here to stay. Demand is elevating. However, supply is relatively flat. It hasn't increased much over the years, and and there's really no expectation that it will. What does your analysis show for silver moving forward, price wise? Do you expect it to hold over 32 in the near term? And are you seeing a large breakthrough at some point?
Yeah, absolutely. I do think that you're going to see, because we're starting to now see really large deficits. This year will be 250 million tons of a deficit. That's more than the last 11 years of surplus, which the surplus wasn't that huge, right? But we did have a surplus. And so those deficits are only forecast to get larger. So, I think that in the near term, I think we could see $40 easily. I think those old highs at 50, it's totally doable over the next 5 years. So silver's just a very hard trade. It's kind of like the redheaded stepchild of the market. But I think that we're kind of pushing those. It's price action is kind of lagging gold, but it's kind of pushing that, I think if we hit over 40, I think then people will really start to take notice as well. And that's where we could really see prices accelerate higher.
So maybe institutional demand increases at that point, or Western retail demand increases at that point. So 40 is that number for you that, I don't want to put words in your mouth, but 40 sounds like it's the number for you that will make people stand up and take notice.
Absolutely.
So I'm sure you've heard this, the latest announcement of Russia's budget released on September 29th, and it outlined plans to significantly increase precious metal reserves. And obviously, for trade settlement purposes, that's understandable, but they included the purchasing of silver in that. This would be a first, as far as I could tell, a sovereign buying silver as a reserve. If Russia follows through and purchases silver to add to their reserves, and even other central banks follow suit, what's the impact and ramifications there?
Well, obviously, then that only propels silver higher, just as we just saw with gold, right? And so, and that, sky's the limit. So I think it's just something to watch, because if we really start seeing central banks starting to purchase silver, it's going to be the train that gold has. As soon as we kind of broke out of that, decade-long consolidation, and prices start to move higher, they really haven't looked back.
No, they have not. They have not.
And it can happen very quickly, and it can happen with silver as well.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. If you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Tracy as much as I have. Please let her know, hit the like and subscribe button, and leave a comment below the video.